You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
So this next hour or so is going to be a lot of fun for me, because not only for the next little bit do I get to play host and introduce our moderator, but I get to hang out up here for a little bit with the other exchanges and interact with them and you guys as well. To herd these cats and to manage what we're trying to do and get things going, please welcome up the CEO of LiquidPoint, Mr. Tony Saliba.
Good to see you. Good to see you. Good morning, everyone. We don't have very much time for this august group, so while they're taking their seats, let's just say a couple things. Great to be here in Texas, isn't it? I think we're all Texans at heart. Being surrounded by all this great Americana that the Hyatt has on the walls made me think that we're involved in the greatest American security. What's more American than options? Great optionality is really important to having a great life. So today I have a pleasure to host a panel with the 7 gentlemen who are charged by their exchanges to maintain that greatness. And I'm going to start with Ed and let them go down the line and introduce themselves.
Myself, right?
Yes.
Hi, my name is Ed Boyle. I'm with Box Options Exchange.
And Jeromee Johnson-Batts.
Gary Katz with the ISC.
Steve Crutchfield, NYSE ICE.
Tom Wittman, NASDAQ.
Shelly Brown, MIAX Options.
Ed Provost, CBOE.
Thanks, Ed. So before we get started, I think it's important. I think last year you all heard, those of you who are here, heard a lot about the CAMP bill that is sitting in Congress right now, and the CAMP proposal is a complete overhaul of the U.S. tax code. And what's important for everyone here to know is that there is some language that is on the shelf, sitting ready to be put into a bill that really impacts our industry in a significant and negative way. And it has a lot of unintended consequences for the government in terms of revenue generation, but it would have a major chilling effect on any hedging capabilities with options. So I want you all to at least be aware that this thing hasn't died yet. The bill probably won't come up before the election this year, but it still exists, and it's very important that people be aware of it and be ready to speak to their congressmen and senators about the negative effects of this language. Trading technology and the prevalence of electronic trading has been in the news a lot more lately with the 60 Minutes piece with Lewis, and it's been really cast in a negative light. These gentlemen run exchanges that, for the most part, are electronic, and what I'd like to do is ask you guys what the flip side of high-frequency trading and the negative things we've heard about electronic access, what innovations recently or in the near future do you have that bring a positive aspect to our users? Ed, I'll start with you.
I can start off. To begin with, without the technology that we've employed in the marketplace, we wouldn't have the possibility of having the growth we've had over the period of time. I mean, back in the day when we were matching trades, pretty much manually, there was open outcry and things like that. Things were as efficient as they could get. We didn't have the ability we didn't have the technology to create it. When computers were invented and brought into the market, not so much invented, but brought into the mainstream, that allowed us to give much more efficiency to pricing. And much like every other industry, you could use the automotive industry or any others, we create something and then we make it better, it gets faster, it gets cheaper, it gets safer. we've done that with the, not only the equity markets, but the options markets as well. It just wouldn't be possible to have the marketplace we have today without the technology that we use. And it's a shame to see it constantly get painted in this negative light that is at the end of the day, it often turns into one person or one person's opinion of the marketplace, and it's got this perception that permeates through the entire public's eye that makes it look like the markets are, rigged or nefarious for all these, the wording they use. One of the things bats were, I just said bats and I shouldn't have, Box was, I'm
That's all right, we're together on this.
Giving you a little credit. Box was founded on the premise that technology was going to make the markets more efficient, and that was done.
So was Bats.
And Bats was as well. So you're right. Okay, we'll keep going. Who can we throw under the bus though? And it was really to give customers a better price at the end of the day through our PIP auction. So we brought in the price improvement auction at Box, and that really was a change for the industry, and it helped the industry. Without technology, that would not have happened. We couldn't have possibly had these electronic auctions. The auctions that happened in the trading pits were nowhere near as efficient as they are in the electronic markets. And that's changed the way customers, the fills they get, the access they have to the market. Andy mentioned earlier how the customers have never had it better. They wouldn't have it this way if it wasn't for the technology that we've got there. And that's when, as I said, Box was founded on that. The other thing we've recently introduced into the market is our complex order book, which has got electronically executing complex orders in a marketplace is not easy to do. It took a lot of years for the options industry as a whole to get to embrace this and get it done. What we've done at Box is created the ability to leg these orders into the market as well, to use implied out, so we're actually implying the customer's complex order into the market. They're going to get guaranteed both execution on both legs at the same time. Again, something that was done years ago by brokers in a very inefficient way, but to the best of their ability, and quite often they got hooked on it and they had to charge a lot of money to do it for that reason. So those are a couple of things we've done. I just can't stress enough how important technology is to the customer experience in our marketplace. Now it's your turn.
Now it's my turn. And so because Box was founded on technology and the root of technology, again, so there's so much synergies with regards to what we do. Going back to the origins of Bats, really echoing that technology is in our DNA. Right? Part of what we do more than anything else is being the technology leader, and that's part of what we were founded when NYSE and NASDAQ were going around and buying up the ECNs. And think about the market structure, and again, all the highlights that we're hearing about today from the book and everything else is focusing on the cash markets. That's Bats' origins. Taking that and levering it into the options market is a decision that was made a handful of years ago. And if you get to the company tagline, that making markets better, how do we attempt to do that first and foremost is through technology. And I want to get back to one of the other data points that Andy had up on the board here a minute ago. Talked about how much of that liquidity provision is being done on an automated basis, right? 90x%, where you got a couple percent being done on the phone, you got a couple percent being done manually, point and click via the shows, in order to deal with the breadth of liquidity that we have in this market, where you will never have those two ships passing in the night and the orders bumping into each other, and you need the market makers really providing that breadth across the whole volatility curve. You need technology at its core. And being able to take that and provide that, again, lets us, not only us as a company, but us as an industry, be able to keep adding and incrementing on those things, whether it's the weeklies or the dollar strikes, the 50-cent strikes, and the things like that. So that being a core part of our operation, us being able to support the market and all those enhancements is part of what we do. Little things for us. In the past few months and in the coming months, you think about some enhancements around what we're doing around the open with some new collars and risk mitigation there. We added some new risk protections for market makers, following on some of the things that some of my competitors have done up here as far as percent of quote and things like that. There's some nice innovations that when it comes to technology, some of those things that you're able to take and lever. We talk about the challenges of fragmentation going from 8, 9, 10, 11, 12, 13, 14 options exchanges, being able to take those things and replicate them in a very good, efficient way. That's some of the benefits of technology that we're able to turn around and bring back here to the marketplace and to you guys. I'm going to stop there. I'm sure we'll spend a lot of time more on technology.
Well, since Jeremy is hosting the conference, we all decided that we would say we're from the BATS exchange. So at BATS, what we're focusing on is maybe it's the obvious, which is not what's negative about technology or the speed at which we're all operating. That's obvious. I don't know anyone that is trading, making phone calls, driving a car, getting on a plane that doesn't appreciate what technology has provided to them. But we have a responsibility as exchanges to harness that technology and to prevent some of the outages that have occurred, some of the larger errors that have created an impression in the marketplace and with our customers that there's danger and that they should be afraid of speed rather than embrace the speed. So the area that we focus on a lot is the risk management. How do we ensure that market makers can get out of the market if they need to? Did we just lose sound? How do we provide kill switches so that people can remove their quotes or their orders instantaneously? How do we use the technology that we have to monitor the types of trades that are being done and ensure they're being done at the right prices? And if not, that we alert the firms that are sending the orders to us so we can check that there's not something wrong in the marketplace. And technology allows us to do that. And so there's a whole suite of services that we provide at BATS to make sure that the markets are continuing to improve and leverage the speed at which they're working. The area that's most exciting, though, for me, is the future. How do we look forward to what we can do? And there's an opportunity to work with the Options Clearing Corporation because they are the one entity that sees all of the trades from all of the exchanges that are up here. They're the one entity that can monitor during the day the risk of a firm, a clearing firm, a market maker, even down to a single customer, if that's something that we want to achieve as an industry. And in working with them, allow us at some point in the future to shut down a rogue trader, to shut down a trading desk that has exceeded their margin limit, not with the knowledge of one exchange, but across all the different trading platforms. So the promise of what is to come is a safer marketplace, a safer car, a safer plane, and an opportunity to continue to grow the industry.
Yeah, so I'm not from BATS, but I want to underscore a couple of points, including particularly what Gary just said. You know, NYSE, unlike some of the guys on my right, obviously we're not an organization that was originally founded based on technology. We were founded, I think, by some guys under a tree in the 1790s. But in a way, if you look at what's happened over the past couple decades in the options industry, it's representative of a larger transformation in the equities marketplace as well. You know, in as recently as the 1990s, if you wanted to execute an options trade, there were some, you know, on the CBOE we had raised, there were other things, but for the most part, you were calling up a broker. And you look at the extent to which in equities, certainly, but also in options, particularly, you look at the extent to which the experience of the retail investor has improved markedly because of technology in such a short period of time, really since 2000, when the options markets first really began to be operated electronically with the launch of Gary's exchange. The transformation is remarkable, right? With multiple listing, with decimalization, with the compression of bid-ask spreads from 3/8 and half-dollar wide markets to eighths and teenies and then dimes and nickels and pennies. The fact that a retail investor can quickly and immediately look at any option on the screen and know exactly where they can buy and exactly where they can sell, you know, very likely whatever amount of size they're likely to need from a retail standpoint. The certainty and the speed of execution, knowing I can click a button on my retail options broker's website, and you know, by the time I'm done clicking the button, I've got a fill. And I know I've got a trade in my account, and I'm good and I'm done, and I don't have to call somebody and worry about what if the market moves, and you know, what if the guys in the pit, you know, by the time my order gets there, that maybe they don't care at that price anymore, and maybe they'll give me a good fill because I'm a customer, or maybe they won't. I mean, it's a completely different and in terms of the bid-ask spread and transaction costs and exchange fees. On many markets, including on the Amex, we don't charge customers fees at all. It's an experience that's night and day improved from what it was, just a few short years ago. And so much of that is due to the innovation and the power that technology has brought to the marketplace and to all participants, particularly the retail investor. So I think that's really, really important. Now, as a couple of these guys have noted, obviously with that come challenges. And as I mentioned, I wanted to underscore Gary's point. I mean, particularly in looking at risk, we believe that working together and working particularly with OCC, uniquely in our market relative to some other markets, where there are vertical silos and other things. We as exchanges don't see all the trades. We don't know all the activity that a given firm is executing. And so I made this example, I think, to someone yesterday. I mean, for all I know, everyone's coming in and someone's coming in doing nothing but selling, naked puts on ARCA, but they're buying every single one of them back on CBOE and they have no risk. But we don't see that. OCC sees that. So we believe it's important, and we're excited to hear the industry and OCC talking about taking steps in the direction of doing some real-time cross-exchange risk controls and ultimately getting to the point where we're able to get a message from OCC to all exchanges saying, hey, this participant is no longer able to execute trades, maybe because of activity that we as individual exchanges are not even aware of. So we certainly have a long way to go, I think, in terms of continuing to improve the functionality of our markets, but the investor's experience has done nothing but get much, much better due to the impact of technology on the marketplace.
So NASDAQ OMX is a global company. Every day that we walk into the office, I realize that we're a technology company. Our days are dominated by technology. Every piece of functionality that we look to build, to try to bring to the marketplace for market makers, for order flow providers, institutions, it's all based on technology. Even down to the evolution from trading floors to electronic. You've seen our floors shrink down to just a few people now, but we continue to even put new technology, as we have just recently on the floor of the Philly exchange with new handhelds. But I think one thing that's important to remember is I think I approve maybe 25 or 35, 40 changes every day that go into our equity, into our options markets. And they're humans that are implementing changes. And humans make mistakes. And it's our responsibility to try to minimize those mistakes, have good backup systems, protect our customers, and continue to evolve and make that a better marketplace. So humans are in the middle of all this. So we look to do a better job as NASDAQ was part of that.
At MIAX Options, we created a new exchange from scratch 16 months ago. We looked at things from a perspective of what can we do better, what can we do faster, what can we do that's better for the marketplace and safer for the marketplace. Risk mitigation is part of our DNA. It is necessary as we go forward. This marketplace is different than the equity marketplace. We trade 500,000 plus different products. We're a quote-driven market as opposed to an order-driven market. We need the speed for those quoters. Speed is not evil. Speed is not as necessary for the retail investor, though. They are trading at mouse speed rather than at computer speed. But to build the protections for the retail investor, to build the protections within the technology for the market makers, for the entire community is very important. It's one of the reasons why we decided to build a system from scratch, build a system that is as fast as possible, build a system that was designed to trade 500,000 plus products as we have in the options market. We applaud the entire industry in the efforts to tighten down the risk controls, the discussions going on between the exchanges and the SEC to enhance the obvious error rules, to coordinate those to whatever level we can is a positive for the industry. We applaud the fact that we're able to look at things from a different light, try to eliminate or minimize the number of bust transactions as much as possible, and try to make those adjustments so we can add certainty to our market makers. Because the market makers in this industry is who provides the liquidity. That's who's driving the growth in this marketplace and allowing us to trade 500,000 products, trade as many contracts as we trade each day, and have so few errors. But I applaud everybody for the efforts they've taken in improving their technology and we need to continue to work together to improve the obvious air rules and mitigate risk as much as possible.
Could you repeat the question?
Sorry.
So, you know, I thought Andy's presentation was fantastic, and any of us in the industry should be thrilled that he is painting such a positive picture for the future of the industry. And one of the points he made was that we've become much more of a global business. Whether or not we're global companies, our products are being used by people around the globe. And certainly at CBOE, as it relates to our SPX and our VIX products, they have tremendous international demand. And our marketplaces in general are the envy of the world, largely because they operate the way they do with a combination of competition, fair and equitable pricing, and efficiency. One of the things we did in 2013, we're continuing in 2014, is leverage our technology to extend trading hours. So last year when I was behind the black curtain struggling to find out if we were up, it had to do with a software implementation related to extending our trading hours in our VIX futures contracts. And it was a rough start, but we got that in place, and we've been very successful with 7 to 8% of our daily volume in VIX futures trading off U.S. hours. That number gets to as high as 15 to 18% on overnight sessions when there's a worldwide event. So extending our trading hours in futures is a leveraging of our technology, and we are continuing that effort, and will in June extend our trading hours to virtually 24 hours a day. And then by the end of the year, we're expecting to extend our trading hours in SPX options and VIX options. And again, that's taking our technology, working with the firms that do business with us, and ensuring that we can do that, and all of the various systems that are dependent upon one another work in concert. So again, I would offer that as something that technology has allowed us to do, and something we could have never done in our old world of open outcry trading.
Thanks, guys. Sticking with the theme of high-frequency trading, I'll start with you, Ed, Provo. Let's talk about how it's different in the options market over the equities market. How high-frequency trading, as it was described, as it's been described in the media, has a different impact, positive impact, if you will, in the options markets.
Well, I think I would start by reminding people, and I think most people in the room would be aware of this, is that the options market structure is dramatically different than the equities. And I wouldn't sit here and say anything negative about the equities markets, because I think for the most part they run in a fabulous sort of way, providing great liquidity to the users of that marketplace. The options marketplace has always been different, and Shelly mentioned, I think, the 500,000 series, and every time I quote that number, I'm told that I'm too low. That's compared to maybe 10,000 names on the equity side. There's the order of magnitude in terms of the message traffic and the infrastructure and options is so much different, and that's a result of a number of things. It's a result of the fact that all options are cleared through the OCC, so we don't have the dark pool concept. Now, that may be a fine concept in the equities world. There's plenty of people who defend that. It just isn't the case in options, and I think that system for all trades occurring on an exchange has worked well for our industry, and probably has limited some of the activities that are noted on the stock side that may not be favorable. The reference to the market-making community. We have a cadre of market-making organizations who provide liquidity in these hundreds of thousands of securities, who without their continuous fulfillment of those obligations, we would not have two-sided markets in all those series. So it's a structure that I think does not lend itself to some of the activities that have been written about, and it's a very different structure that I think puts us in a great position to continue to prosper and not be reliant upon the kinds of firms that are engaged in the equities business.
Anybody have anything to add to that? Tom?
Yeah, I wanted to first say that I woke up the other morning and my wife said, who's here with me today, she said, "What's HFT?" I said, "Why are you asking me that?" She said, "You talked about it all night in your sleep." But really, so
Who is HFT?
So, and it's
I
really,
want to know who was HFT.
who is HFT?
exactly. So I just want to take you through a little bit since, my world's changed a bit in the last 9 months, and I've been involved with the equity business and running that for NASDAQ. So I want to kind of take you through what we talk about, how we think about it, so we can kind of relate it to options, and I think it's important for us to think about it. To start, for NASDAQ equities, we try to define what HFT is, and it's a different animal. I think HFT gets bundled into HFT is bad. I can tell you that all HFT is not bad. We try to classify it really to order to trade ratios, which obviously based on numbers here, if you have an options you can't do, but we came up with 60 to 1, 80 to 1, 100 to 1 order to trade ratios, which we try to, being driven by our investors and the public trying to understand how do you measure what HFT is. I think what it gets down to it's not the fact that it's those ratios, it's the algorithms that those institutions use to trade and whether or not those are good or bad. But there was a BlackRock study that came out, which we spent time looking at, and they tried to basically put HFT activity into a couple of buckets, and I think it's relative to our business. The first one was, and they tried to grade it from green down to red, good to bad. And the first was passive market making, liquidity provision, obviously like our market makers in the options business. The second was, and still good, was arbitrage trading, pairs trading, indexes versus ETFs versus the baskets, futures versus the equities and options and how those are traded. Still legitimate strategies and good business. Also in the green area, started green to yellow, was rebate trading, which you see in equities, but you see also in options a little bit. The same kind of firms that you consider HFT in equities that do in options, usually they're better in ETFs, they're better in front months at the money, where they can do some rebate trading, but ultimately they're going to have to take on a position, which is unlike some of the equity trading. Latency arbitrage, which started to become questionable. With fragmentation in the equity markets, as we do have some in the options market, latency arbitrage, as talked about in the quote-unquote book, is there, but it's, when you have fragmentation, you have latency arbitrage across the industry. And then where it gets into the red area is predatory algorithms, which I think is, incumbent on the exchanges to surveil for those, identify them, and take action against those. So we could probably come up with some of the same buckets for options as far as strategies. But the options business, as Shelly referred to, has been built on market maker liquidity. And where it's different in equities, you really don't have the designation in the equity markets as customer, firm, BD, market maker. And you can kind of segment those areas. You can take a look at how they play in the marketplace, what benefits they're adding. So it's the market makers in the options business is what has helped build our business. There's less fragmentation in the options market. I know there is some with the number of exchanges, but I think the driving factor which hurts the equity markets is the amount of fragmentation, the amount of trading that takes place off exchange, and it's largely driven by the trade reporting facility, TRF. So in closing, I think really what separates the good actors from the bad actors, not the fact that they're co-located, that they're latency sensitive, it's more about the algorithms that these firms can deploy that may fall into that predatory range that we've got to watch out for. And I think that, as an options industry, we've got to watch for this. We've got to learn from what we've seen in the equity markets, whether it's data dissemination, does everyone have fair access to our proprietary data? What is that versus our SIP in the options area? So let's learn from what's happening, taking place in the equity world, and make sure that we're, in front of the curve on the options side.
Anyone else on that?
Well, so just two quick comments, thoughts to maybe tie the first two questions back together, and then I'm going to exercise my prerogative as the host and get us all some water while we're talking up there, because only one of us I see so far was smart enough to bring it up here ahead of time. So Ed made the comment that we don't want to become dependent in the options markets on some of those same guys that are in the cash markets. Maybe a little bit different perspective of that from my standpoint, where part of the growth that is available to us in the options markets is the continued movement of some of those guys and expansion of some of those strategies into other asset classes. So again, not a question of dependence, but can we see them and help them become more successful in the options markets? Whether that's folks at the institutional level that are going from, plain vanilla cash only to now expanding some of those strategies, or whether those are the automated market making, liquidity provision. We talked about the rebate, front month at the money, where some of that stuff works. It breaks down pretty quickly when you go a little bit out the spectrum as far as where and how you manage that risk. One of the things that, tying it back to your first question, that helps all of this come together is that technology that we were all just talking about in the very first question. Right, the cash markets, and Bats was called out and highlighted, and again, we feel very, very good about our position and what we've done for the cash markets in the book that we keep talking about, and TV and everything else. Technology has been a good thing. There are risks that come with the technology. It does have to be managed. Technology breaks. Right, I was having breakfast with somebody earlier, and where's JP? He was showing me his black screen, and he's like, hey, something's going on with this thing. My email's showing up in someplace different than what I did. We are dependent on technology. It breaks, but we can manage that. The other thing that technology enables is resilience. So when one of us does have an issue and an outage, and one of us is down, and there's a self-help declaration or something like that, and hopefully and thankfully that doesn't happen very often, the technology that is around all of us continues to let us trade and the market function, and we're able to keep going. So that technology, although there are risks associated with it, the net benefit is a positive for the marketplace, and we can keep enabling new players to come to the market and participate and do good things.
Yeah, on that point, I mean, I think, excuse me, something that gets lost often is there's a distinction between fast and slow and between good and bad, right? And there's a distinction between high frequency trading and latency sensitive trading. We've got market makers, as a couple of us have mentioned now, who have affirmative obligations to provide liquidity and that are measured pretty stringently. Exchanges have different rules on our markets. A directed market maker specialist LMM has to be quoting in a meaningful way 90% of the time. Thank you. In order to continue to act as a market maker. So because these guys have obligations, they're providing meaningful liquidity throughout the day, all day, every day, but they are latency sensitive. Options are a derivative product. If you're going to be providing liquidity, you've got a lot of exposure. You've got potentially hundreds of thousands of bids and offers out there in the marketplace. And if there's an event, if the underlying moves, you need to be able to quickly get out of the way, or you're going to find that you're subject to adverse selection and you lose money a lot of the time whenever you make a trade. And so the result of that is market makers, sort of by definition, have to be latency sensitive in order to succeed. And the successful market makers who are able to accomplish that are able to provide tighter markets, which results ultimately in a better experience for investors. Now, there are ways we can improve that further. There are rules and mechanisms we can put in place to ensure that it's the right participants who are engaging in activity on our markets and in the right way. We have, for example, on our markets, we have something called an excessive bandwidth utilization fee. We charge for activity beyond some level that does not result in executions. That's something that some of our affiliated futures markets do as well. We found that to be a very useful tool in ensuring that there's not excessive bandwidth being consumed by activity that doesn't result in volume, which is ultimately what it's all about. It's about giving fills to investors who come in to trade options on our markets. We're launching a price improvement auction, which we call Cube, within the next couple of weeks. It's an opportunity for orders to get filled at a better price than the price displayed on the screen. So we're very excited to be joining that competitive space with yet another offering, which will provide further choice for firms and investors. So the markets can be improved, and I don't know that anybody's saying that our structure is perfect, but the importance of having all those quotes lit up in the hundreds of thousands of series that we trade on our exchanges, and being able to have those bids and offers available for trading requires market makers who have obligations, and their unique importance in our markets, I think, can't be stressed enough, because those quotes are the best advertisement for all of our businesses in attracting investor interest in the options product.
One of the areas that we didn't talk about yet is the difference in market structure, not number of series, but the fact that there are TRFs and dark pools and equities, and they don't exist in the options market. And I think you have to go back in time to the development of those dark pools and the ability to trade retail equity flow off exchange, and how that has developed over time into the need for a different type of liquidity provider. Some people call that liquidity provider HFT. HFT seems to be the gremlin that everybody just, if anything goes wrong, it had to be HFT that is the problem. When I think back to the flash crash, I remember Mary Shapiro at the time, first reaction was it was HFT that caused the flash crash. They must have done something to cause it. A little more time went by, and people recognized that, in fact, the high-frequency traders had pulled out of the market when all of the firms that had been internalizing retail flow suddenly dumped it back into the equity markets, and there was no quotes on the screen from HFT, and Mary Shapiro's reaction to that was, we've got to create rules that enforce HFT staying in the market. So all of a sudden they became the savior, that they needed to be there, and it was the fact that they weren't that caused the problem, which points to how difficult it is to define what HFT is. It is such a broad category, and it points to one of the benefits that the options industry has. And I will keep reminding the regulators every time we go and we talk to them that one of the benefits that the options markets have is that all the flow has to come to the exchanges. And it doesn't matter how many exchanges there are, but it must come to the marketplace to interact with the liquidity providers, and can't be internalized and put on a TRF, because ultimately that drives a completely different market structure. It requires you to have to pay people to put up liquidity in the marketplaces. It creates an environment where you, as a market maker, only trade with toxic flow or the exhaust. It is not a healthy market structure, and it's something that we have in the options industry. We need to protect it and cherish it, because ultimately it's the best experience for the customer. So it scares me when I hear talk of just getting rid of maker-taker. That's going to solve the entire problem, because maker-taker is not the beginning of the problem. It's really the end of decisions that were made that led up to it. You need to have maker-taker in the equity markets, because if you don't, you're going to have empty screens. But you have empty screens because nobody wants to provide liquidity to a subset of order flow. So conversations about trade-at rules combined with maker-taker make sense. Conversations about pilots to eliminate dark pools make sense if you ultimately want to solve the problem and figure out where the abusive practices are under the heading of HFT. You do have to look at this holistically. You need to look at the entire picture and start from scratch and rebuild back up.
So just to jump on that and be real clear, and when we talk about maker-taker, the incentive scheme that you're talking about maker-taker, and multiple of us, not just BATS, have a maker-taker on different parts of our exchanges. Maker-taker, and you said it's not part of the problem. It's it's something at the end. Maker-taker, the incentives that you're talking about there, in my mind, are very much good incentives and right incentives for the market. Under a maker-taker pricing scheme, the person who is contributing to liquidity discovery, the person who is contributing to price discovery and size discovery, the firm that is taking the risk of putting the orders in the market is the one that is getting paid. A firm that is taking advantage of that and removing liquidity and taking advantage of the price discovery and size discovery out there that has been placed in the market is being charged for taking advantage of that. Now, again, that maker-taker is still the vast minority of what we see in the options market. It's a piece of it, but I don't want to pick on maker-taker. Make sure that I have some very clear what it can contribute to the market. It's certainly the vast majority of what we see on the cash markets, and like I said, there are other reasons and other market structure questions around why and how it makes sense. But maker-taker, I don't want to pick on it as something in the options market that is something that's a dirty word. A lot of us have it for different reasons.
There's a perception piece here that I think a lot of people miss as well, and it was talked about. I mean, Tom did a pretty good job of going through the list of, what is HFT kind of defined as, and we've all talked about that HFT doesn't have a clear definition. The shame of it is that it's painted with a broad brush, and it's always pointed to as this, nefarious problem that's out there, and it really has a lot to do with, a lot of the market makers on the equity side have adjusted to HFT type strategies because they've had to. If we look back, all we got to do is go back in history and start to look at market makers in the equity markets were doing the best job they could at the time, but then it was determined that they were doing things wrong, all the way back to the odd eighths problem in the 90s, going back into the, what was going on at the NYSE with the specialist units. It all led up to order protection rules, fragmentation, ultimately NMS, which created what we have today. We live in a rules-based environment. So when rules are created, the participants have to live by those rules. It's a very bright line that they can't cross. The problem is you can not play to that game, or rather play against the spirit of it. And I think that's where a lot of this confusion comes to. I've heard a recent definition of someone said, well, HFT is considered a trading firm that uses sophisticated technology to trade in rapid fire succession and has an appetite to go home flat at the end of the day. That pretty much describes any trader. If you can go home flat, God bless you. You can't really do it in options. Can you trade in rapid fire succession? You better, or you're going to be out of business in today's world. So it's this broad, again, a very broad brush that they're painting it with. And I think that's what we've got to be careful of with the industry-wide, the press as well, that we don't continue to point to this as something wrong with the industry, but rather something, as Jeremy pointed out earlier, that we can possibly make better in the marketplace. And these guys can actually participate in it because they're good actors for the most part. Yeah, do we have some bad apples out there? Certainly every market or every industry is going to have that, but that's what our regulators are for. That's what the rules are for. That's what the bright lines are for, is to find that and call it out. And we do a really good job of that. A huge benefit of technology is that it creates a very robust audit trail. When a trade takes place, we know exactly where it took place, when it took place. Does it take a long time sometimes to go through that data? Yeah. Are we getting better at it? Yeah. The Chair White has said that she's going to be focused on data. She's creating tools to go after that. That's, I think, a big part of what we need to go after. And then the risk mitigation side of it, which all the exchanges are working together on. And the whole idea of risk and where it sits, we talked about OCC is the only one that's got the ability to see the broad risk across all the markets. But analyzing risk is really about the entire trade, the entire trade process as it goes through. You can't say I'm going to manage risk just at OCC or just at an exchange or just at the clearing firm. It's got to be managed throughout that entire trade process as it goes through, and that everybody has to work together in doing that. So this is much more of somewhat of an industry effort than we can point to a single place or a single time or point to just HFT, just OCC, or just the exchanges.
So technology has allowed us to do a better job with regulation and taking a look at what's going on with the equity underlying market and our options market. Hopefully it can fold in futures. It tells the entire story that we could never see 10 years ago, cause and effect.
I just wish they'd get rid of the red light cameras, though. I hate those things.
Don't get me started about that. Regulatory body. I can define high-frequency trader. I used to stand next to the original one, Richie Kerrigan, in the crowd. Trade about 1,000 times a minute. Regarding risk, which Ed touched on, with the maybe 5 or 6 minutes before we get into some questions. Opinion on how much risk mitigation should the exchange environment bring to the marketplace, besides fat finger, obvious error situations? How much interconnectivity, if you will, to mitigate risk for its members?
I think it's in all of our collective best interests as businessmen, aside from being regulators as well, to ensure that our marketplaces operate in such a manner that if it's our mistake or the order sending firm's mistake or the market making organization's mistake or a predatory customer's actions, that we have in place systems that protect all of the parties and ultimately downstream to the OCC. So I think everybody here clearly has touched on, if not more thoroughly reviewed, their risk mitigation technologies. And I think that They're only going to get better, and we may touch on the work streams out of the SEC initiatives a little bit later, but one of those is ensuring that we all have in place collectively, not necessarily identically, kill switches and other systems to ensure that customers don't blow themselves up, the exchanges don't find themselves burdened with trades that should not have occurred, and that ultimately nothing gets passed down to OCC that was not what was intended at the beginning of the stream. So I think a real solid effort is being made in the industry among competitors that oftentimes are at each other's throats, but in this case, trying to work together to come up with mechanisms to ensure that the marketplace is a safer one for us on the options side. And because, again, the options market structure is different than the stock side, many of these work streams have resulted in option-centric initiatives which are distinguishable from the stock side for a good reason. So I think that we're doing a great job as an industry from the middle of last year forward, and I think there's a lot of work that's yet to be done.
We believe it's certainly essential that the exchanges provide tools to their members and the clearing firms to protect the market integrity, protect individual firms. Systems mistakes, they happen. Systems go down. But one of the key questions I think we need to two key questions. One, should this be a competitive issue? Should we all be able to go down our own path? Do we all have to harmonize what we're doing in terms of offering risk protections or not? But more importantly, what do we impose on our members? Is it the exchange's responsibility to impose a risk limit on a market maker, for example? Am I supposed to tell a market maker the maximum amount of risk you're supposed to take? Or should I provide tools to those market makers and the order entry firms and the clearing firms at a second level to impose their own levels of protections? We should provide the tool. We believe we should provide the tools to the firms to set the levels as they want to set them. We shouldn't necessarily impose specific risk levels on individual firms.
It's probably the latter, because we don't know and have visibility to where our market makers are on your exchange and your exchange, your exchange. You know, the activity that we're seeing on our exchanges, maybe it's good, maybe it's bad. We don't know what their offsetting positions are, so it's kind of tough for us to do it. We can atomically protect them at the trade level and kick them out based on what they tell us to do, but it's hard to figure out.
The other piece
to Gary's points earlier, OCC is the only one that has the ultimate view of what everybody's doing.
And that's probably not fast enough, though.
Mm-hmm.
You know,
yeah, I
we
would
can
agree
make
with
it
that. I don't
faster.
think it's fast enough. I think one of the areas that a lot of people miss, and you touched on a minute ago, Shelly, that people say that, well, risk tools shouldn't be a competitive issue amongst exchanges. That's wrong. They are a competitive issue amongst exchanges. With the exchange that can create better risk tools, we're encouraged to do that by our members. We recently had a conversation with a large clearing firm. They're telling us the exchange that creates better risk tools that allows us as a clearing firm to manage our customers better will be rewarded by us. It is a competitive issue, and it should be, because competition drives a much better product at the end of the day. The competition we create in the market drives a much better product. Having non-competitive, it's not just the markets themselves, it's the tools we create, it's the access to the markets, it's the way we allow customers to trade the price they trade at. So the risk tools are in fact a competitive issue, and I think they should continue to be one, because they'll get better over time.
Well, and that's the right side of the competition story. I think we are all aware up here today, and the regulators are aware of as well, and the OCC is looking at this. The flip side of that coin, from a competitive standpoint, what none of us want, what none of you want out there, is somebody to come along from an exchange competitive standpoint and say, you know what, I have no risk controls, you can go as fast as you want, you can trade as big as you want, and that puts us all, no pun intended, back at risk. And so making sure that we have the appropriate backstop, so we never see the flip side of that competitive coin is very important.
Yeah, the regulators have to have a control level on it, and at the end of the day, I think the industry now understands risk enough too that they would, an exchange like that would just simply not survive well.
Well, I mean, on that topic, Ed, you touched on in the previous topic, risk management doesn't mean anything unless you know the beginning and the middle and the end.
Yep.
You know, my opening here and closing there. So I think there is a degree of interconnectivity, OCC possibly being the hub, but really I see a universal like ring fence on all the exchanges so that when somebody enters into it, you know the starting position and go against a metric that's agreed to.
Yeah, that's critical to it throughout the process. And again, that's the fact that I'm able to do it faster than a competitor, vice versa, is what's going to give one of us the early mover advantage.
Exactly.
Everybody will follow it.
Yeah, and I think you're right. It should be competitive.
Absolutely.
Otherwise, where's the innovation?
Exactly. The innovation disappears.
And not to jump the gun, because I think we may come back to this topic, but speaking about the SEC work streams, I think this is a really good story for the industry, because all of the exchanges have made commitments to the SEC about how we're going to be enhancing our risk controls. You've seen over the last several months, I expect every single exchange up here has introduced new and more sophisticated controls, or will be. We introduced for the first time a couple months ago global risk controls, so incorporating all the symbols together into a single metric. That's going to be expanded. We're going to be enhancing our opening price checks and doing other things. I expect all the other markets are going to be doing the same based on commitments made to the SEC. I think it's terrific, as Ed mentioned. We've heard a large clearing firm talking about imposing standards on exchanges, saying, here are the standards we want you to meet. I think it would be great to see that expanded across the industry. Versus a couple of years ago when this issue first really, I think, started to get a lot of attention. There's been a tremendous amount of improvement, and I think, we're all sitting here next year. It'll be an even better story than it is today in terms of what those protections are across all markets.
So we got about
one word of caution, though.
Oh, I'm sorry, Gary, go ahead.
I'm a little concerned when I hear almost everybody at the same time say that that's not fast enough if we do it through OCC. We can't try to achieve perfection on day one. We will not be able to accomplish the ultimate goal, which is to improve continuously over time. So it may very well be possible that in the first iteration of cross-market controls with OCC, that it's not an automated switch, it's a manual call to the exchanges. You have to shut this firm off. And yes, that might take 5 minutes to get out into the marketplace, but it's much faster than what exists today, which is nothing. And that 5 minutes will ultimately be automated, and it will get faster over time if we try to set a standard of perfection, of the fastest thing possible. I don't think we'll be able to do that together as an industry, because we're on different life cycles at our exchanges. We have different priorities, we have different development cycles in all of our firms. Ultimately, we want to achieve what's best for the industry, but setting a line in the sand and saying, in 7 months, if you're not here, you shut down. From ISC's perspective, that might be great for me, because I might be ahead of the pack in terms of all of this risk management, and I feel very comfortable with that. That's not really how I want to compete with the other exchanges. I want to work together and get to a place in the future that protects the market makers, protects the customers, and ultimately helps grow the business. We will not achieve that if we just set hard deadlines, if we do these check the box, this is what you must build, as opposed to a principles-based approach. So as OCC has gone around and talked to all of us, one of the key words that they used was a principles-based approach. They're not going to say, these are the 7 things you must build, every exchange must look the same. In fact, I believe that if all of us build the exact same controls, we put the industry at greater risk, because then we're not really backing each other up. And one of the advantages that we have in this industry is 12 exchanges trading the same products. We are primary and backup to each other. If we all build the exact same models and the exact same risk controls, we will create greater risk in the marketplace, not less.
Risk is not just mitigated with technology. It's mitigated by proper obvious error rules and proper mechanisms for managing positions once an error takes place. We need to really look hard, which we are doing as an industry, at how we can adjust or bust. Busting trades are evil. Putting a trader or a market maker in a position, somebody that did nothing wrong other than put a market on the screen, make a trade, hedge that trade, have that trade busted. It's just not fair to that market maker to take the potential unlimited losses associated with that unhedged hedge. We have to really look hard at how we manage trade busts as opposed to adjust going forward.
So I want to tie that obvious error message together with something that Gary just said. So, and without getting too far down the different work streams, but just an update for everybody here. And I know Ellen from SIFMA mentioned yesterday briefly. So we are to the point today where the exchanges have collectively come to an agreement on where we are going to harmonize the obvious error rules, and appreciate all the help and the work that the other exchanges have done in getting us to that point. It's to Gary's thought on, with the common centralized mechanism at the OCC where we have a third-party view, where we are at today and what we have agreed to. There's some things out there that we're not ending up in necessarily the ideal world, but we've come to a point where we know here's some next stage things that we want to get to. We want to do some things around parity. We want to do some things where maybe the OCC, likely the OCC, will be an independent third party to help us determine the theoretical value in certain cases. So we'll get to some of those things, but there's so many other things that we've agreed to now that we are locking it down, moving it forward. We have a draft in front of the commission. We got our first feedback on that last week, and it's important to get this over the goal line and wrap it up and get to a spot where we have those harmonized rules that we have all agreed on right now and get it in place for everybody as soon as possible. And then we can get to that next step and that next step, and we can continue to make things better. But let's get over the goal line what we have finished, and not go down a kind of separate path of, you know what, BAT's at some point, we joke about BAT standing for Buddy All Trades Stand, right? We're in a very good spot with the harmonized rules, and we need to get those wrapped up.
We agree entirely. We appreciate the support from BATS in putting this together.
Okay, guys, well, we have about 8 minutes before we get the hook. Are there any questions out there? Okay, Dan? So you first.
Just yell.
Just speak. Yeah.
Oh, here he comes.
I don't have a technology question.
He's right.
But Tom has the answer written on his cheat sheet.
Okay, Tom. Yeah. No, I don't have a technology question, but I was able to join Alan Grigoletto and Eric Katz to make an introduction to Options 101 to a state pension fund that has just $60 billion in assets. The first time they have ever looked at options. So there's 49 more states. The one thing I want to ask this panel is, what are we going to do as an industry to capture those other 49 states who've just ridden 5 years of upside and don't have any idea how to manage that risk today?
Reduce regulation.
Tony, let me take a shot at that. So yeah, the industry's best marketing has always been education, and the toughest nut that we've had to crack over the 40 years that we've existed as an industry is the institutional space, and most specifically the pension area, because listen, and this came out in spades in our work on the tax law, there's still a perception out there that as the option product falls under the broad umbrella of derivatives, that it's something that's risky, that adds risk, that only Wall Street fat cats use, and it's not something that the average investor can and should be using, and that quite frankly, most every pension plan with equity exposure in the country should be using. But there are so many obstacles that we have found that still exist in terms of mandates, boards, and all of those groups that limit what a pension plan portfolio manager can use in terms of the products and the strategies. And I'll say shame on us for not having been more successful over those 40 years, but I think we've actually made great progress. There's a lot of work to be done. So it's a great question. I think that we've talked a lot about what a great world it is for the retail investor, and there's no natural obstacle to retail investors using the product. There's been firms that have been created as option boutiques to specifically go after those clients whose full service firm may not be quite servicing as much as they would. But the institutional space has these unnatural blocks where a portfolio manager might be completely sold on implementing a covered writing program or something as simple as that, and yet not be able to do it because the board mandate won't allow it. So there's plenty of opportunities, a lot of untapped potential, and we've got to work both collectively as an industry through our OIC, and then individually as exchanges to make sure that we make greater progress in that regard.
Sandy?
I'd like to ask a panel a question. But the elimination of competition has also increased fragmentation of our markets.
introduced things like dark pools, which go against its primary objective, which was transparency of the markets. And things from time to time require fine-tuning. So I'd like to ask the industry leaders what they think would be appropriate market structure changes that the SEC or Congress could implement to improve our markets.
Wow.
You talking, Sandy, on the equities side or the options side?
On both. I think they're
Both.
so linked that you can't separate them.
Wow. Anybody want to
So
take a shot at the equities? Yeah.
I'll give it a shot. I don't think I can really give the answers of what has to be changed, but I think we need a process. And it's really, I see it more on the equity side of the business because of the fragmentation, 50 different venues where you can execute. I think it's more of a process of exchanges, SEC, and some of our customers getting together and taking a look at make-take, honestly, take a look at payment for order flow, look at locked markets, look at exchanges that come into the new exchanges come into the marketplace with de minimis market share over a period of time, and if they don't reach a certain market share, their quote becomes unprotected. I think we've got to take a look at all those issues and put them together and figure out how we modify Reg NMS. There's been some good that's come out of Reg NMS, and there's been some other things that have happened because of the implementation of Reg NMS, unintended consequences, in my opinion.
I would
Go ahead. Francis.
I would add that the regulators could act as a safety board, no different than the safety boards in the airline industry. When there is an outage at an exchange, and when there is an outage, and there always will be, what we don't have today is a gathering of all of us as exchanges, and all of them, equity, options, and futures, to identify what occurred. Is it something in the software, or in the hardware, or in the network, or the technology that we should all know about, that is not competitive, but that as a safety board would be shared with us on a non-public basis, so that if there was something that we needed to do to change something in our system to prevent that event from occurring again, that we could all do so. And that's whether it's at the exchange level or at the firm level. There are events that happen, and we continue to be somewhat blind to what's occurred. So yes, there are lots of market structure issues that can be addressed, and I agree with the entire list, and you can just keep adding more. But ultimately, in the end, it's only going to grow more complex, and the regulator is uniquely positioned to bring us all together so that we can learn lessons from each other.
Our options market structure is superior to what we have in equities, though.
Yeah,
that's one of the things that could be looked at, and I agree with you. It's look at the option market structure closer. If the current dark pool matching took place, but then had to be brought to a lit market and auctioned for some very short period of time prior to printing, I think that would solve a lot of problems in the equity market. But again, I'm not saying that's the answer. The problem is when you go down this path, as you pointed out, that Sandy pointed out, that NMS was designed to create more transparency, and in fact, it went the other way. That's, I think, you got to be very cautious when you make these changes.
Well, and that's so our SEC speaker tomorrow, we have Greg Berman will come and he'll spend some time here, and he will talk
tell us
about.
a secret?
He's going to talk about why and how the commission is doing data-driven analysis around the markets in order to come to those conclusions. So rather than the wholesale making sweeping changes from a market structure standpoint, making sure that we do real data analysis and carefully step through what the actual facts are and what the numbers are, and don't do it based on hyperbole and rhetoric that we're watching on TV and things like that. One thing that was mentioned that I just want to reinforce, we talked about a small incremental change that could lead to some pretty dramatic simplification, more in the cash markets than the options markets. But you talk about that locked market question, right? How many order types have grown up around dealing with and managing and prohibiting and doing, just that one thing, is that an incremental thing that could vastly simplify some of the rules and programs that we have in place in the cash markets. So that's, tomorrow you'll get to hear directly from the commission about how they're approaching some of those things.
Guys, thanks. Tony, I'm sorry. There's a quick one. We got 1 minute.
So this goes back to a year ago. My question's for, sorry for my voice, for Steve. You asked me some questions about competitive responses in PIP and the data around it. So I spent some time reviewing it over the last year. And keep in mind that PIP's now produced approximately $500 million in aggregate price improvement to retail customers. So my question is, I wanted to compare the data to the experience of price improvement at your exchange, and I couldn't find any data. So is there some guy under a tree that I could go see to get that?
Tony, you get that cold from sitting in coach?
I think we're out of, I think we're over time now, Tony.
Time out. Time out.
Well, you got to sit up here to answer those questions.
Yeah. Why are you sitting down there? What's going on?
Yeah.
All right. We'll look forward to it.
I want his boots.
Yeah.
Thanks, everybody. Thank you.
Yeah. Thank you. So.
We need 2 hours on this panel.
That's perfect. That's perfect. Yeah, no. And thank you. So, and you see it up on the screen. Please join us in the exhibit hall. Spend some time with the exhibitors. Get a quick break, and we'll be back in here for our next panel in about half an hour.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.